Thank you for joining me. I'm Gord Long. A reminder before we begin, do not trade from any of these slides. They are commentary for educational and discussion purposes only. Always consult a financial advisor before making any investment decisions. The global issues appearing daily can leave few with any other feeling than the world is quickly destabilizing. This is not some sort of the world is coming to an end statement, but rather an observation regarding how rapidly threatening events are occurring that, if not managed properly and on a timely basis, could easily spin out of control and cause serious unintended consequences. Last week, the ECB convened a rare emergency meeting only days after its regular meeting and then refused to make any statement on the reason for it. This is highly unusual. Something's wrong. In parallel, we have the markets abuzz as a major player has taken a short against the Japanese yen that could only be comparable to the size George Soros historically took against the UK pound before it collapsed. We have major hedge funds now stopping redemption flows. On Thursday, the third largest short volume on the US S&P 500 was placed. The dollar can't stop rising in a global flight to safety, and the list just goes on. Something is broken somewhere, but many suspect is currently being kept under wraps to stop the markets from unraveling too quickly. What is at the core of the instability, in my mind, is the increase in the global money supply since the 2008 financial crisis versus the weak expansion of real global economic growth during that period. The global economic system was already fragile, unbalanced, over-indebted, and excessively leveraged before COVID. Then COVID-19 hit. The reaction to COVID in pumping a further $29 trillion into the global economy, while effectively at the same time shutting down the productive element through lockdowns, was an impulse that ignited raging global inflation. It was like a spark in dry kindling where inflation had not existed. Suddenly, it upended the financial credit and lending systems. Like an earthquake, the damage takes a while to be felt, and only now is the true force being realized. Like a forest fire, it can quickly get out of control. The mistaken policy belief that inflation was transitory delayed the reaction function and allowed the fire to burst onto the global stage as a financial incinerator. The question is whether the global policy leaders can wrestle it under control. I want to cover the subjects listed here to give you a better idea of the clear warning signs we are being given that everything is not as rosy as our leaders want us to naively believe. Let's start with the data and what is actually happening versus what the media thinks or wants us to believe is occurring. Since the beginning of the year, we've experienced the largest giveback of paper wealth in history. The total value of stocks and bond losses combined is over $15 trillion globally. Remember, this is after injecting the $29 trillion in global response to COVID-19. Global sovereign bond losses are on course to experience the biggest loss since 1920. Anything even close to this marks seminal events in world history. We need to appreciate that the Basel Accord demands banks immediately adjust their loans outstanding and investment portfolios to offset the banking risk that lower bond prices create structurally. There is therefore massive readjustments that is occurring out of sight. These forced adjustments are no doubt causing serious problems for both overextended lenders and borrowers. There are consequences of being in line with what they call value at risk. I continually discuss in these videos that credit always leads market turmoil. Equity market collapses are always a credit event. As bad as the damage has been so far in the global equity markets, capitulation in the form of cumulative flows has only so far been realized in the credit markets. Seldom, if ever, have I seen the equity markets not follow the credit markets. The dislocations in the reduction of negative yielding bonds outstanding are truly stunning. As yields rise, the approximately $18 trillion in negative yields had to be absorbed in an unprecedented capital losses. A lot of these holders were not regulated banks operating under Basel VaR requirements, but rather institutions and shadow banks, likely highly leveraged. This chart of the U.S. high yield or junk bond market is as graphical a representation of any as I can find of the market to show that the market is broken and steadily collapsing. The global risk-free benchmark, which is considered to be the U.S. 10-year note, is shown here based on the increase in yields. The benchmark doesn't rise this fast unless something is signaling major monetary mistakes are occurring. It is significantly ahead of the Federal Reserve and its Fed's fund rate, as well as seriously behind the rate of inflation. Investors around the world are scared and are looking for places to protect their money. The US dollar or euro dollar has normally been the quickest destination. It has been a long time since the US dollar rose at an exponential rate as shown here. Besides the data, we have a major war in Europe not seen since World War II, a structural global energy crisis that seems only to get worse with no solution in sight, a looming global food crisis, collapsing residential and commercial real estate due to exploding mortgage rates doubling, global shortage across the entire supply chain, which has yet to feel the Chinese lockdowns of 400 million people in the industrial heartland and key import-export ports of China. This is about as depressing a picture as I can recall seeing since getting into this line of work a few decades ago. The central problem here is there are no actions being taken to solve any of these problems by global elected politicians. They seem overwhelmed and incapable of any form of coordinated action. As you would expect with politicians, they have delegated the solution to these economic problems with their central banks. Central banks are equipped to solve demand problems. They have never been tasked nor have any expertise in solving supply problems, where a lot of the problems with inflation and shortage stem from. Therefore, let's briefly examine what the key central banks are doing and the challenges they face and whether there is any possibility of the central banks actually halting these crises before the momentum and unintended consequences overwhelm the global system, a system that at best can be described as fragile. The Federal Reserve increased the funds rate by 75 basis points last Wednesday to 1.5 to 1.75% during its June 2022 meeting. This was instead of 50 basis points that had previously been expected until the CPI and PPI reports were released, that came in with blazing hot readings and month-over-month increases, which have signaled that inflation is still accelerating upward. The red line shown here, overlaid on this long-term S&P 500 chart, shows the history of the Fed funds rate. The dotted red line shows the maximum it was able previously to be increased by before the Fed was forced to dramatically reverse direction. You can see on the left axis, this is exactly where we are now after the last 75 basis point hike on Wednesday. What are the chances of the Fed continuing at this rate or even a shallower 50-point rate in the next two summer meetings? Highly unlikely, I think. The chart shows that every time the Fed reversed is because it broke something serious, which took the economy into a nosedive, and the Fed couldn't lower rates fast enough to mitigate the damage. Will this time be any different? Since the chart goes back 5 decades, the chances are good that it will repeat in some fashion or manner, that is. Maybe something is already broken, as I mentioned earlier, and it is being contained, like the ECB emergency meeting, the Japan's unlimited buying of any BOJ treasury instrument they can create. Maybe it will take another hike or two. However, it seems inevitable. Certainly the bond market is signaling this, and in fact it believes the Fed has its monetary policy wrong. You don't tighten when the economy is slowing down. You don't raise rates nor reduce the central bank's balance sheet when you are staring down the barrel of a recession. You just don't do that, if that's sincerely what your plan is. Maybe it's just a lot of narrative. The Fed is swinging from delayed liftoff to over-tightening. The Fed should have been tightening the moment Biden assumed power and began spending programs and tried to pass others all measured in the trillions of dollars, something we have never done and bigger than the cost of World War II. The well-respected Financial Managers Survey clearly shows that professional money managers believe the Fed has it wrong for whatever reason, and sees it as the biggest potential risk to financial market stability. We believe the Fed knows full well it will never implement quantitative tightening to any real degree before it reverses it. It is once again job-owning, but few are paying much attention to them anyway. Clearly, investors are nervous, and we can soon expect global equity flows to reverse negatively and likely aggressively to the downside. That actually hasn't happened yet. Obviously, we don't see the Fed coming to the rescue of the world's problems, at least not until something breaks and they have the political cover to reverse their strategy. But what about the EU and the ECB? Christine Lagarde and the European Central Bank is currently in a pivotal position. The ECB has been resolutely more dovish than its counterparts, and far more reluctant to embark on trimming its balance sheet or raising rates. That has changed, and last month's blog post from Lagarde more or less promised that target overnight rates would be back above zero in September. That represents a big shift. The move in European fixed income market has been seismic. The rise in the 10-year German bond yield over the last 6 months has been the largest this century, a German tantrum for the ages. Shown here is the rolling 6-month change in German 10-year bond yields as percentage points. That change has come swiftly as the debate intensifies over how far the Federal Reserve will need to raise rates, and as I mentioned, whether it will be forced to cut once more accidents in the economy occur. In Europe, the overnight index swaps market suggests that the upward adjustment didn't really start until the end of the first quarter this year and is now in full throttle. There's a reason why this is happening. First of all, inflation in the Eurozone has come as much more of a surprise than the rest of the world, as I show in this chart. The extent of the surprise has been driven by the severity of the inflation. In Europe, its natural gas prices over the winter, followed by the war in the Ukraine, created a huge rise in prices. German producer price inflation is now 33.5%, comfortably the highest since the current series started. The ECB famously hiked in the summer of 2008, ahead of the credit crisis, and then again in 2011, just as the region was about to lapse into the sovereign debt crisis, and this explains why it has proceeded cautiously. The conflict in the Ukraine also affects the economy's ability to withstand any tightening. That leaves a range of possibilities unusually open. The ECB announced it was ending its quantitative easing asset purchases this month. Yes, it is a tad remarkable that it is still intervening to keep yields down when producer price inflation is over 30%. Lagarde is also expected to follow through on rate hikes starting next month. Deviation in either direction, with the market still rushing to catch up with an evolving shock, will have global repercussions. Personally, I smell another sovereign debt crisis already occurring in the southern EU countries, similar or worse to 2012. Italy, for one, has massive loans to Russia and is committed to the Chinese Belt and Road Initiative with outstanding loans. Others smell the same thing that I do, and I suspect it will soon erupt. This chart of the spike in Italian borrowing costs rings of something no longer working properly. Currently, the yen is rapidly depreciating. It is a direct consequence of the Bank of Japan's aggressive actions to halt yields from rising. Japan can ill afford higher interest rates with its massive debt levels. However, as the Bank of Japan tries to stop rates from rising, they weaken the yen. Japan is in a trap. They can protect interest rates or the yen, but not both. Further, its actions are circular. As the yen depreciates, inflation increases, and the Japanese central bank must do even more quantitative easing to keep interest rates capped. The graph shown here illustrates the recent depreciation of the yen in blue. The graph charts the amount of yen needed to buy a dollar, ergo, the rising amount represents depreciation. With interest rates capped in Japan and rising in America, you can see the widening difference in yields in orange. Essentially, the graph highlights the stark contrast between the Fed's hawkish policy and the BOJ's extremely dovish policy. The BOJ, with full government support, appears willing and able to do everything in its power to keep monetary policy extremely aggressive regardless of what other central banks do. Such a stance by the Japanese central bank might be possible if inflation remains tame. Japanese inflation is much lower than in most other major economic nations. However, there are signs that prices may catch up. For instance, the price of input goods, PPI, has begun to rise rapidly. While CPI is still low at 0.9%, we must consider that PPI and inflation's expectations, shown here, often lead CPI. Japan may be already experiencing a jump in CPI that the government is minimizing, or that the data is simply lagging. Either way, this inflation impulse is far different from minor impulses in the past. Further, given the surging price of global commodities and Japan's lack of natural resources, it will be near impossible to avoid inflation. Many politicians say inflation is good because Japan's massive debt levels. It can essentially reduce the amount of debt as a percentage of the economy. It appears that for this reason the bank wants more inflation. However, with more inflation, the Bank of Japan must expand even greater efforts to ensure interest rates do not follow inflation higher. That's the rub. So what happens if CPI data starts rising rapidly? More importantly, might high inflation and the limited means of many of Japan's citizens force the BOJ to take a more hawkish stand to limit inflation? Doing so would involve fighting yen depreciation at the expense of interest rates. This hawkish scenario, which hasn't been seen in Japan in 30 years, is deeply troubling. A strong yen and higher rates will entice liquidity flow back to Japan. The yen carry trades will be reversed as their borrowing costs rise alongside an appreciating yen. Such is a recipe for a global drain of liquidity and possibly a financial crisis. Japanese citizens and pension funds will start to bring their money back home to take advantage of higher yields without the currency risk. Such a reversal of liquidity is not a Japanese-centric problem, as the tentacles of the yen carry trade spread through global financial markets. The loss of liquidity will be felt worldwide. The bottom line, the Bank of Japan is trapped. They are conducting unlimited quantitative easing to keep rates low, but at the same time weaken the yen, which promotes inflation. Unlike many other economic pundits, it is not the collapse of the yen that is our chief concern. It is the opposite. The Bank of Japan has avoided inflation for 30 years. The onset of inflation might be too much for them to evade. In case you are not interested in Japan, simply understand that the Japanese carry trade has been the global source of cheap money for decades. Impeding this in any fashion where the world has relied upon the carry trade has potentially massive far-reaching impacts. This leaves us with China. China has saved the global economy on 4 separate occasions since the 2008 financial crisis. We've outlined this in prior videos. Though the Chinese credit impulse is now rising, it is in response to domestic problems centered around 4 million Chinese being locked down and with the Chinese economy being effectively shut down for Q2. China cannot be expected to save the developed nations and global economy now for the 5th time. Clearly, we cannot expect the major global central banks to solve the quickly expanding list of structural cracks in an already fragile global economy. The real issue is the abuse of proven policies of sound money. The global fiat currency regime is now in trouble. It will sustain itself, no doubt, but at a very serious and broad-based cost. Much lower standards of living in the indebted developed economies are in front of us. An accelerated shift towards a multipolar world, and with it stronger real collateral now being required. Commodities and the southern nations will become increasingly more powerful over the next few years. It is why I've been talking about the coming global super cycle in commodities. If you haven't seen it yet, I encourage you to review the latest macro analytics video where Charles Hugh Smith and I lay out the foundations we jointly see emerging. As I've always remind you in these videos, remember politicians and central banks will print the money to solve any and all problems until such time as no one will take the money or it is of no value. That day is still in the future, so take advantage of the opportunities as they currently exist. Investing is always easier when you know with relative certainty how the powers to be will react. Your chances of success go up dramatically. The powers to be are now effectively trapped by policies of fiat currencies, unsound money, political polarization, and global policy paralysis. I'd like to take a moment as a reminder, do not trade from any of these slides. They are for educational and discussion purposes only. As negative as these comments often are, there's seldom been a better time for investing. However, it requires careful analysis and not following necessarily what have traditionally been the true and tried approaches. Do your reading and make sure you have a knowledgeable and well-informed financial advisor. So until we talk again, may 2022 turn out to be an outstanding investment year for you and your family. And I sincerely thank you for listening.